Okay, so that was the introduction. So let's go to the next stock we're going to look at. I picked Adobe. I hope everyone's okay with that. And we're going to continue with this sort of theme of software. Again, it's easier when you are looking at an entire sector to come up with investment ideas and things like that. So let's go to Adobe stock, $98.93. Let's check the number of shares. The stock price in and of itself doesn't mean anything until we know how many shares there are. There's nothing we can determine from the stock price. It's like saying, well, each piece is $99, but how many pieces are there? We don't know. We have to look. This is the 20th lesson, I believe, so there are beginner lessons where I very slowly and patiently talk about the basics of investing. All right, so there's about 500 million shares outstanding. And so every one of them is worth $98, so it's roughly $50 billion. It's a $50 billion company, Adobe. Isn't that amazing? And we know that that's about the size of Salesforce.com, isn't it? About the size of Salesforce.com. Let's see how much cash and debt they have, because that, as we've talked about many, many times, plays an important factor in all of this. All right, 886, 379, 3432, 029. What's amazing is you have companies like Adobe that are a more established, slower growing business, and they're not doing the things that Salesforce is doing. Like Salesforce is an extremely aggressive acquirer and investor in startup companies, whereas Adobe isn't doing any of this stuff. And it's sort of telling, I think. It's quite telling. All right. Adobe is growing pretty handsomely, maybe not at the pace of Salesforce. Totally different business model, or is it? Totally different products, at least. All right. You can see in 1 quarter, it's about 1.4 billion in revenue. Which annualizes, if you think about it, to what, 5 or 6 billion a year. Let me take the last year. You can see they're growing quite handsomely. The product revenue is going down. That's the packaged software. The subscription fees from the online software are going up. And we'll talk more about that. That's kind of what's going on at Adobe right now. You can see the revenue growth is 20%, which isn't quite Salesforce, but that's still quite a lot. Still quite a lot. All right, let's keep taking a look here. Cost of goods sold, 202,079, so very, very high margins. Gross margins of... Most software has high gross margins. Your developers are your cost there. Cost of delivering the software isn't very much. Then, of course, your next highest expense is your salespeople, sales and marketing, their advertisements, and so forth. And R&D is an interesting cost. It's kind of difficult to account for, but presumably your programmers are working on new software and updates to software. Again, tricky to account for. We'll maybe can explain that some other time, but software has some of the most interesting accounting. somewhat difficult accounting policies sometimes. Alrighty. Alright, so what can we tell from just one quarter? Of course, not a lot, but we can tell a few things. The company is growing pretty substantially, at least that one quarter. The company has very high margins, very profitable, unlike Salesforce.com. And the operating margin's also significant. This is a more mature software company. But if you look at the amount of revenue, it's not that different. And we'll see what that tells us in a minute. All right. Let's quickly look at one more quarter. I don't know what Harambe would think of Adobe, but this gets very easy when you can copy and paste the formulas. You can see quarter over quarter there's not much growth here. That could be a seasonality thing. But again, these are mature products, Photoshop and so forth. Strange tax rate aberrations here. Let's do one more. Good thing about Adobe is they're a classic fiscal year. A little off actually. They have their year ends. Spoke too soon, huh? Year ends November 27th, 2015. This year ended 11/28/2014. Well, there goes that. Here you can see, well, hold on, let me bite my tongue there for a second. This can be very boring, but it's also, it doesn't take much time, which is a good thing. Especially if you get used to it, this is not very hard, and it's very important information. And again, you can see that the packaged software side, like buying the actual Adobe products, is dropping somewhat dramatically, while the subscription version grows somewhat dramatically. So they're making that transition in their business. And you can see the revenue growth of 20% for many years for a company that had sort of been written off in many ways as a old line company. This has reinvigorated Adobe shares and transformed the company quite a bit. But we'll see what that looks like in a second. Yeah, everyone's trying to implement this style of business, there's no doubt. Everyone wants to look and feel like a software as a service company. No doubt that their software is certainly right now very good, and they're able to, as the industry leader and the standard bearer, kind of have these kinds of, probably got some pricing out of that move to a cloud-based system. Higher prices is something I'm very familiar with. Always a good thing if you can charge your customers more and more every year. That is something Warren Buffett teaches. Pretty much all investors understand how pricing power is a very powerful driver for businesses. No communists here, I assume. Munger would be proud. I don't know. He talked some smack about Valiant. And again, my contention is Valiant's problem was bad acquisitions, really, not pricing problems. Yeah, we can go buy the Adobe suite, see how much it costs. It looks like their transition to cloud is just about done, but maybe it's not. Again, that's sort of got to be careful on that larger number stuff. You can see the revenue growth here, 9%, and who in the world would have dreamed a jump to 21% revenue growth? That's the kind of thing that takes you by surprise as an investor when a company all of a sudden. But if you're prepared and you know what the company is ready to do, and you talk to the company and you listen to the conference calls and you stay on top of your game, these are the kind of things you can notice ahead of time. You can see it also improved their margins quite a bit moving to the cloud, probably because it improved their pricing. You can see their cost of goods sold didn't rise very much, but revenue did. One more quarter. Is it a leap year? I forget. Doesn't matter. When is their fiscal year end? Let's see. November, right? So this is Q416. This is Q316. I'm pretty sure all this is right. Yes. Okay. Let's go do some annuals real quick. What's fireworks? Yeah, no, there's a limit to price increases, no doubt. I mean, you can't just do it forever, and it depends on the products you're selling, obviously. So we're gonna go through that in a minute, and we'll see how much of this was driven by pricing versus new users. It's possible they had unit growth, so don't necessarily assume that it's pricing. Haven't used fireworks, but again, I'm not a graphic designer either. Nor do I know this market too well. But that's why I'm doing this. It's a good time to learn. All right, 4562. That is not the number. I think I messed something up here. Hold on. I think I had these right the first time. Q4. Yeah, I did. Silly me. Take a second to fix. Well, when you're a company, you have to buy software. You can't steal it. That's not a good. It's not a good look, as they say in my neighborhood. Wait, this has to be say November 27, 2015. Yeah, I got that. Okay. Ah, I see what I did wrong. Cool. Yeah, could you imagine a design company saying, yeah, you know, we just steal Photoshop? I don't think Adobe would be too happy. Nor is that company wise to risk, I don't know, prosecution or something. Never smart for a business to steal things. All right. All right, here we go. Let's do one more. for this. And you can see the dramatic decrease in product, which is package software that you can buy at a store, like a Best Buy or something, and the dramatic increase in the subscription business. Really an amazing transition that was well managed by the company. Basically, could you imagine a business saying, well, we're going to stop selling software this way, we're going to stop selling $4 billion a year of our main product this way, and we're going to start selling it that way. It's really, really big kind of thing to do. It's a colossal task, really. So maybe 10 years after they should have, they transitioned to the cloud like Salesforce.com started a long time ago. It's kind of an interesting parable, or parallel, I should say. Parallel, not a parable, it's a parallel between the two companies, right? Better late than never. In their case, it worked out really well. And you can see that in 2014, they had a paltry 2% revenue growth. And this is why the market values these companies. It's pretty interesting. You know, they have similar valuations. Salesforce.com has a little bit more revenue and a lot more growth. So we're going to talk about maybe, who knows, maybe shorting Adobe and going long Salesforce.com. That would be a classic kind of hedge fund trade. Could be fun. It could be wrong. We might want to go long both of them. We might want to short both of them. It's way too early to tell, but that's the kind of thing that's going through my mind right now. And you can see here that they actually used to have products were more. This is so bizarre. Products were. It's not that bizarre, actually. I'm just reading. It's sort of tough to read. You can see the subscription business started from nothing, really just nothing. And the transition has occurred. But what's amazing is even though the transition is almost completely done, revenue really isn't that much more than it used to be. And in fact, in 2013, they shrank quite a bit. Maybe Adobe is a really big short, but we have to think about what kind of opportunities do they have going forward. We're still just barely getting familiar with this company, but again, my mind is racing a million times a minute with the excitement of a potential investment or bet, if you will, in the case of a short. You can see they used to generate $1 billion, presumably this is at peak, in net income. So for there to be a $46 billion company seems a little awkward to me, given that there's not a lot of growth in this very kind of old business. These are old and tired brands, Photoshop and so forth. So this really could be a wonderful short. The company paying dividends doesn't change anything about the business. You can do whatever you want with your cash flow. You can keep it, reinvest it, pay it, give you a dividend, and you could do whatever. It doesn't make a difference. It doesn't matter to me, at least. You really hurt this experience if you talk about things that aren't related to investing. So please don't do that, or I may be tempted to not do these lessons anymore. All right, here we go. That'll occupy my time trying to find you. Okay, one more year, and you can really see that their transition from a packaged software company to a enterprise software as a service type company is pretty amazing. All right, let's see here. But at best, if the company was doing $1 billion in free cash flow, it would seem to me very awkward to want to pay 50 times that amount. But again, we still have some work to do here. But again, you can see that the company is certainly at record high revenue, but I'm suspicious of this. Very suspicious. If you've been in finance for your whole life, you've been using Excel your whole life. It's a little like, I guess, Photoshop, right? Similar to how an artist might be using Photoshop. All right, so here you can see that they really have grown their revenue pretty dramatically. The subscription is still rather small, but let's see, they were only at 3.8 in revenue. So they had a small hiccup over these last 4 years transitioning to the subscription model, but they really are a growth company in many ways. Let's keep looking though, because I'm not satisfied with just a couple of years. It doesn't take much time to plug them in. And I think this is interesting to look at the landscape of company over a decade and look at their financial performance. Remember, as you plug in these numbers, these are thousands of employees working hard, millions of customers. Really an interesting thing to behold in many ways, and all available for your consumption on the SEC's website, which is pretty neat. It's the biggest design company in the world, but they can't hyperlink their HTML file. They should use Dreamweaver for that. So you can see the subscription business just starting here in 2009. And really rapid growth. Muy rápido. 3 billion, 3.8 billion, 4.2 billion. Then this lull in this transition period, and now 4.8 billion. Thank you, Amber. Right, almost done here. I'd like to look at one more year, would you? Again, to me, fascinating to see the development of such a household name, really, Adobe. Who hasn't heard of Adobe? Such an ever-present name. And we'll get to see, finally, how much money they actually make on things like Acrobat, which I would imagine is not a lot. I think they make most of their money on Photoshop, but I don't know for sure. There are definitely companies that are too expensive, no doubt. That's the underlying kind of. Here they have the links in this document, but on the other ones, there are companies that are way too expensive to invest in. That's the whole point. You can have a great company, but if it's not the right price, it's like a bargain, right? It can be a fantastic, meal, right? It could be the best burger in the world, but you wouldn't pay $1 million for it. If there was a burger just as good at $200 instead of $1 million, and then there was a burger maybe half as good at $10, then a total trash burger for $5, you got to decide which to go long and which to go short. But it has to be relative to the value that you're getting. There's a good burger here. The best bang for the buck is at a place called P.J. Clark's here in New York. P.J. Clark's is half a mile from here, and you can get a great burger for not a lot. $10, $8, something like that. It's a sit-down restaurant, but it's something else. So here, I was just about to give up on looking at these numbers, but you can see here they go from 3.6 to 3 to 3.8. So you have this really weird growth pattern that is kind of emblematic of a mature company. It's fascinating to me. I'm more and more convinced that the stock is short, but again, I have to hold back my feelings on that and just chill out for a minute, and let's look at one more. I keep saying let's look at one more, and then we find more and more interesting data. So here's 2007. The company does not have any subscription revenue in 2007. So they decide to join the cloud in 2008, which is not bad. I mean, the cloud was just kind of getting started in 2005 and 2006, so Adobe wasn't too late to the ball game. But you can see that despite the going to the cloud, they didn't gain a whole lot. Maybe they perpetuated their franchises and they guarded against threat, but it doesn't look like they've gained a whole lot. So if you want to calculate what is the revenue growth, you do rate, number of periods is 8, 2015 minus 2007, and you can actually do this negative here, positive here. See, the compound annual growth rate was 5%. Not quite what we've seen from Salesforce.com, which was, I don't know, let's over the same exact period, let's actually see 2007 to 2015. Yeah, it's going to be an interesting number. 35% revenue growth versus 5% for Adobe. So to think of them as a software as a service company, it's a little bit nonsensical. Yeah, I've always assumed Microsoft will eventually buy out Adobe, but right now it's rather expensive. I'd pay $20 billion for Adobe. I wouldn't pay $50 billion. And what's remarkable is if you look at the operating income, it's been a consistent $1 billion since the company started. And this idea that they're a much different company now is a little bit ridiculous. Let's take a look at the stock price over the years. I'm going to use Bloomberg, but you can use Yahoo Finance or anything else for that matter. So in 2007, the stock was $42.73. So this is a little bit of the opposite example of what we were just talking about with Microsoft, and that's why these you can really take advantage of situations like this. I love taking advantage of situations. Sounds creepy. All right, so here you have this rapidly rising stock price, right? Rapidly rising stock price, but no change in business conditions. I mean, the company's a little bit bigger, but it's not double bigger, which is the stock is, right? There's more shares outstanding, so you want to be a little careful. There's less shares outstanding, but what's kind of interesting is the EBITDA hasn't changed. It was $930 million in 2007. It was $973 million last year. But the stock price is double where it was at. So people think, again, why is that? Well, ROIC, discount, near-term earnings, maturity. People think that the discount rate has dropped. It's dropped because the company successfully transitioned from packaged software to software as a service, which is their big risk, is that the internet would make these things disappear, right? Near-term earnings, well, they're sort of growing nicely right now. 16% revenue growth is more than they've had in a long time, and that for some reason their maturity and long-term investments are probably unchanged. But the market certainly thinks that this level of $1 billion it's not created equal from the $1 billion they're making in 2007. That it's more secure, or it's more prone to grow more quickly now, or certainly subscription is nice because you know that the money's coming in. If the user has to cancel their subscription, so that's called visibility. You have excellent visibility that the earnings are going to be good. Whereas every year, hoping and praying that someone's going to buy the package at a Best Buy or wherever was something that was a little more unusual and difficult to forecast. Having said that, I don't buy it, and I think the stock could be short. But we'll have to keep examining this. Let's take a look at, especially given the kind of margins they have for the kind of software they provide. Have to do a survey of some graphic artists or whoever their customers are, and go through that. So let's look at a most recent 10K. Let's see how the company describes themselves. Yeah, so the discount rate would be lower if the business is more stable, which we all know is good. So of course they immediately say software as a service. That's the buzzword, but that was the buzzword 5 or 10 years ago. Let's see how they can. Creative Cloud. Photoshop, Illustrator, Premiere. Let's write these down. Creative Cloud. Photoshop, Illustrator. I'm assuming you can use all of these at once. Premiere Pro, Photoshop, Lightroom, I guess that's the opposite of Darkroom, and InDesign. All right. Adobe Stock, so there's stock images and things like that. Behance community, 5 million creative professionals. That's kind of neat. Dreamweaver is even a product anymore. Let's see, digital media, Photoshop, Elements, Premiere, Elements. These are the basic software. Digital Publishing Solution, Typekit, some mobile apps, really. Document Cloud. I suppose that's PDF or Reader. Acrobat. Alright, let's take a look and see if they segment this anymore. Hard to tell what the difference between Illustrator is and Photoshop. I guess it's in the name, isn't it? No, Premiere is video, right? About Lightroom, After Effects. What about these? InDesign, just page layout. So let's see, other offerings are from Apple, Autodesk, Avid, Corel. Let's see, Avid, Autodesk, Apple, Corel, Microsoft, Quark, Getty, Shutterstock. Digital marketing business. I don't know what that is. Shantanu Narayan. It's like an Adobe lifer, huh? 1998 to 2016, almost 20 years. So we have to keep track of these subscriptions and things like that. It really does look like their transition to this model is going to increase revenue ultimately. It may not look like it right now, but if you look at paid subscriptions, fiscal 2015 was 6.167. So we're going to have to keep track of that. And some of these other metrics, we're going to look over them for a second, but here's their reportable segments, so digital media, digital marketing, print and publishing. Not totally surprised. Digital media, $2.2 billion, digital marketing, $0.9 billion. This is out of subscription revenue. Prefer to look at it like this. So it looks like it's been 2/3 digital media and 1/3 digital marketing. Adobe Campaign. Sort of like probably what Salesforce does. Maybe more around sort of ad campaigns. Oh, one last thing about Salesforce.com that I noticed as I was looking at the company. They have a really US-centric kind of base. So you can see here that US is, or America is 70, which is mostly US, is 73% of revenue, And as we know that there's a lot of these enterprise software companies in Europe and Asia Pac will probably become customers over the years, which is probably good fuel for further revenue growth. Another reason to be bullish on Salesforce.com. Well, they mentioned Corel, so I don't know why they would do that. I don't know if Corel died, but I'm kind of curious actually myself. What happened to Corel? Well, looks like it exists. Corel Aftershot, etc. Corel Corporation. Doesn't look like they died. Looks like they've got a lot of competitor products. Even if they don't have, even if they're not. Hey guys, sorry about that. I very unwisely positioned my foot on the power button. Got about half an hour to go in today's investing lesson. Promise I'll give you these extra 5 minutes. It was not Hillary's fault. Don't blame her for everything. Gonna test Microsoft's auto recover features here. I gotta upgrade my foot. Make sure I don't hit the monitor. Alright, show recovered files. Okay. Thankfully I saved quite a bit in the compulsion of pressing Control plus S. If you want to learn Excel hotkeys, you can go study them yourself. Alright, Salesforce.com. How about Adobe? Alright, I got all of it. Doesn't look like I missed anything. Alright, so we can just jump back in. Okay, so I think we got a picture of what Adobe does. We got a picture of sort of what their financial situation is. Let's now look at the near term. I think it makes a lot of sense to look at the near-term situation and really try to understand if this move to cloud is going to propel them to the $5 or $10 billion revenue situation, which is kind of what they're going to need to go to justify the stock price. So here's the this is their conference call script, the 10Q, earnings press release. Let's just look at the press release. Creative growing 37%. All right, let's write that down. Creative. So here they're saying creative was 755. So this is basically Photoshop, right? And the same deferred revenue principle applies to Adobe. It's a very important piece of the puzzle here. June 3rd, 2016. Oh, I mean, I do this for every company I look at, absolutely. Especially if they're financially oriented, like they have products, for instance. Even if they don't have products, they have future products, like a pipeline. This is the same sort of method. Right, so here's the all-important deferred revenue. As we all know, deferred revenue is revenue the company hasn't collected yet. Sort of an interesting concept. Services provided, but revenue has not been booked. Yeah. Balance sheet, and you can guess what's next. Cash flow statement, of course. We have 3 months ended here. Very close model net income and reported net income. We have all the add backs. Of course, stock-based compensation, which I don't view as a proper or appropriate add back. Deferred revs, working capital. We have cash flow from operations of around 500 million, 489. Okay, now we're going to try to do our own free cash flow type of understanding. So here's obviously CapEx. We have investments, which don't really count. And of course acquisitions. Oops, screwed all this up. It's always interesting to but fill out the acquisition line, because we see sometimes even this really small acquisitions that are done. A lot of fun. So we can actually do our own sort of cash flow from operations. So we'll do cash flow from operations and add back stock-based comp and add CapEx. And this gives us a really much better look into real cash flow, and we can see that it's 349 million. So 349 times 4 is 1.4 billion, which is still 33 times earnings, which I think Salesforce.com is a much better deal than that. So those are 3 cash flow statements. A little weird that I get a different number. Oh, I see. That's why. Perfect. Cool. So that's a little bit of surgery on the income statement and cash flow statement there. And you can see that the non-GAAP net income is 357, which is very close to our surgically derived kind of non-GAAP net income. I always like to see. Let's check out one more press release. And it's weird because they give out pieces of different information from time to time. It's kind of interesting. Here's Creative 733. But the subscribers, I'm kind of curious how many subscribers they have. They give this ARR number, which sounds very important. We got to look at that in a minute. Here's the all-important deferred revenue, which is a indicator of future revenue. See, it jumped a little bit quarter over quarter. Definitely a good sign. But we got to think about how much it has to go up. Deferred taxes. Let's take a look here. Reported net income, model net income, very similar. Do all the add backs. Some working capital adjustments there. CapEx, pretty modest. CapEx is lower than D&A, which is telling you that earnings are being under or overstated, everybody. CapEx is lower than D&A, or earnings understated or overstated. No, earnings are understated because D&A depreciation is higher and CapEx. CapEx is future depreciation. D&A is the D&A that's being removed from the income statement, and CapEx is capitalized on the balance sheet. Excess tax benefit. Okay, so it looks like 2 quarters in a row they had roughly $350 million of our kind of definition of real free cash flow, which is very interesting. I mean, you know, it's only 2 quarters, but it's still important to look at. Looks like maybe URL error here or something. Maybe not. Come on, Adobe. You can find it here. Well, looks like my internet's broken. Or something's broken. Let me see for a minute here. Mike asked a good question earlier, which is how do we look at deferred revenue, and it is on a year-over-year basis. And we know that Salesforce.com is a little bit of a different perspective on unearned revenue, and they even have like unearned and unbilled revenue, which is kind of an interesting perspective. So we got a good flavor of Adobe because I'm having some computer difficulties. I think I'm going to cut this one short. Appreciate everyone coming through, and we'll continue this one where we left off next week, and we'll probably do, let's see, what else should we do? My guess is we'll do